Did you know that nearly 60% of high-income earners don't have a solid investment plan? Shocking, right? They're making a lot of money, but not all of it is working for them. That's where value investing comes in. The truth is, a high salary alone won't make you wealthy. If you don't know where and how to invest, all that income could disappear faster than you think. But here's the good news: you don't have to be a financial expert to master this. In fact, you don't need to chase after the latest trends or risk it all on hot tips. What you need is a clear strategy, an understanding of value investing, and patience. It's about making smart, calculated moves that add up over time. In this video, we'll break down the exact steps to make your money work harder for you. We'll dive into the perfect order for investing if you're a high-income earner, starting from the basics of securing your financial foundation to the strategies that allow you to grow and protect your wealth. Stay tuned, because by the end, you'll have a plan that's simple, effective, and tailored just for you. Chapter 1. Unlocking the Power of Patience. Why timing isn't everything. Value investing is all about spotting undervalued stocks that the market has overlooked. Warren Buffett, one of the world's most successful investors, says, "The stock market is a device for transferring money from the impatient to the patient." High-income earners can use this mindset to find great companies trading below their true value. The strategy isn't about gambling, it's about research, patience, and buying when others are fearful. One powerful way to find undervalued stocks is to focus on the price-to-earnings (P/E) ratio. A lower P/E ratio often means a stock is undervalued, but remember, it's crucial to assess the company's financial health first. A good rule of thumb is to look for businesses that are out of favor but have strong fundamentals. For example, during the 2008 financial crisis, many companies saw their stock prices fall even though their core businesses remained solid. Investors who bought at the right time, like those who invested in banks such as Wells Fargo, saw their investments soar as the market recovered. But finding these gems isn't just about the price tag, it's about understanding what makes a company undervalued and having the patience to wait for the market to realize it. Another key factor in this strategy is analyzing debt levels. Companies with too much debt are risky, no matter how cheap their stock seems. Always consider the debt-to-equity (D/E) ratio. A high D/E ratio can signal financial instability, while a low D/E ratio often indicates a company is in a better position to weather market downturns. Don't just look at the headlines, dive deep into the balance sheets. Research is your best friend here. Chapter 2. Building the Fortress. Secure your financial base first. Before jumping into value investing, it's important to build a solid financial foundation. For high-income earners, this means securing an emergency fund, paying off high-interest debt, and optimizing tax-efficient accounts. These initial steps provide stability, allowing you to make investment decisions without worrying about short-term financial pressure. A good rule is to aim for an emergency fund that can cover 3 to 6 months of living expenses. This ensures that no matter what happens, you have the resources to weather any storm. High-interest debt, such as credit card balances, should be paid off before investing. The interest on these debts can eat away at your wealth faster than most investments will grow. Next, focus on tax-efficient accounts like 401(k)s and IRAs. These accounts allow your investments to grow tax-deferred, giving your money more room to compound. They're especially valuable for high-income earners who are in higher tax brackets. Building this financial safety net first will set you up for successful investing in the future. Chapter 3. Mastering the margin of safety. Where to place your bets. The margin of safety is one of the key principles of value investing. It's the cushion that protects you from market volatility. Think of it as an insurance policy for your investments. For high-income earners, this means buying undervalued stocks or bonds that have a significant margin between their market price and their intrinsic value. The margin of safety isn't just a concept, it's a practical tool for reducing risk. If you buy an asset for $50 that's worth $100, you have a $50 margin of safety. This ensures that even if things go wrong, you're still protected. For example, during the COVID-19 market crash in 2020, many stocks plummeted in price. Investors who had a margin of safety could continue holding their investments, knowing that the underlying companies had strong fundamentals that would lead to a recovery. It's essential to look at a company's financial statements, debt levels, earnings potential, and competitive advantage. If a company is undervalued and offers a strong margin of safety, it's a good opportunity to buy. Just remember, it's not about chasing high-risk, high-reward stocks, but investing in businesses with solid, long-term potential. Don't forget to subscribe. If you're finding this valuable, hit the subscribe button so you don't miss the next chapters in this series. You'll get more tips and strategies that will help you grow your wealth over time. Chapter 4. The Dividend Dream. Let your money work for you. When you're a high-income earner, you want your money to keep working for you, even when you're not actively working. This is where dividend stocks come in. These are stocks that pay regular dividends to shareholders, providing a consistent stream of income. Dividend-paying companies tend to be stable, established businesses with a long track record of success. Companies like Coca-Cola and Johnson & Johnson are known for their reliable dividends, which can be reinvested into more shares or used as passive income. High-income earners benefit from dividend investing because it provides a regular cash flow, which can be especially useful during retirement. One of the keys to successful dividend investing is focusing on dividend growth. Look for companies that not only pay dividends but have a history of increasing them over time. This ensures that your income will grow with inflation. Reinvesting those dividends into more shares can also fuel the compounding effect, allowing your wealth to grow exponentially over time. Chapter 5. Alternative Assets. Go beyond the stock market. While stocks are an essential part of any investment strategy, they're not the only game in town. For high-income earners looking to diversify, alternative assets like real estate, private equity, or commodities can offer new opportunities. Real estate, for example, can provide steady cash flow through rental income, as well as long-term appreciation in property value. According to the National Association of Realtors, the median price of homes in the U.S. has increased by more than 250% in the last 20 years, making real estate a powerful investment tool. Private equity is another valuable alternative. By investing in private companies, you can earn higher returns than you might get from public stocks. However, this comes with more risk and requires more research to ensure you're choosing the right opportunities. Diversifying into commodities, like gold or oil, can also hedge against inflation and offer a store of value during uncertain times. Alternative assets are an essential part of a well-rounded portfolio, and they provide a buffer against the volatility of traditional stock markets. Hit that subscribe button. If you haven't already, make sure you're subscribed so you can get more strategies and insights for smart investing in future chapters. This knowledge can take your wealth to the next level. Chapter 6. The Art of Rebalancing. Don't let your portfolio drift. One of the most important aspects of investing is rebalancing your portfolio. Over time, your investments will grow at different rates, and this can cause your asset allocation to drift. For example, if stocks perform well, they may make up a larger portion of your portfolio than originally intended, which could increase risk. Rebalancing is the process of adjusting your portfolio to return to your target allocation. This can involve selling assets that have grown too large and buying those that have become underrepresented. It ensures that your portfolio stays aligned with your long-term goals. High-income earners often have larger, more complex portfolios, which means they must rebalance more regularly. This could be once a year, every 6 months, or even quarterly, depending on your risk tolerance and investment strategy. By regularly rebalancing, you keep your portfolio in check, prevent overexposure to certain asset classes, and make sure you're staying on track with your investment goals. It's a simple but essential strategy that helps you avoid unwanted risk and stay on the path to building long-term wealth. Before you go, don't forget to subscribe. You've just learned the foundation of smart investing for high-income earners. By subscribing, you'll get more in-depth insights to help you grow and protect your wealth over time.